Okay, a lot of people are arriving right now, so I think we just wait another minute for everybody else to log in, and then we will start with today's panel. Okay, welcome to today's panel, Profit is Fiction, Cash is Fact, Cash Flow Management and M&A. So just to summarize what this panel is all about today, cash flow management and how to sustain good control over short-term cash flows and working capital has never been more critical for business than now. And also turbulent times, the M&A market is always an interesting area, since companies with healthy financial situations may find it interesting to use the opportunity and buy some competitors or also enter the US market. With that having said, I just wanted to seize the opportunity to quickly introduce myself. My name is Gerrit Ahlers. I'm the Director of Consulting and Corporate Development Service here in Chicago with the German-American Chamber of Commerce. And together with my team, we support German companies in entering the US market, but also expanding in the US market. With that having said, I just wanted to also provide you with some ground setting rules for today. So everybody who is attending will be muted during the presentation. If you have any questions you want to ask one of the panelists, please use the chat function. So you can write in the chat function your specific questions, and we will try to answer them in between the whole panel. Also, if you have any questions, there's a function that you can raise your hand, and we have some people in the background who will basically make sure that all your questions will be addressed. If we can't address your questions, we will make sure that after the panel, we reach out to you individually. With that having said, I also want to give our panelists the introduction to introduce themselves each and every individually. So today, next slide, please. So today we have Frank and Bernward and Jennifer and Janine on the panel. So now the stage is yours. I pretty much appreciate if you guys would introduce yourself, and we also have some supporting slides for that.
Okay, thank you. I will start. My name is Frank Breitenfeld. I'm a partner with Rödl Partner, and I lead the transaction services practice of Rödl Partner here in the US. I joined Rödl Partner in 2012. Before that, I worked for 15 years with Big Four, first in Düsseldorf, and then in 2005, I came to Atlanta straight away, and then in 2012, I switched over. The first 2 years as an expat, and then I recognized how awesome the beer tastes in America, and I decided to stay. So now I'm a German American. I have 2 passports and a daughter of 4 years, but she was not an anchor baby. I met my wife after I got my green card, so happy to be here. Bernhard, do you want to go ahead?
Yeah, I'm going ahead. Bernhard Holt. I joined Rödl Partner 2020 in the earliest days of the year. My responsibility here is the supervision of our BPO department. That means taking care of finance and controlling processes outsourced from our clients to us. Most of my professional career, I worked as a director of finance and controlling or as a CFO for several manufacturing companies in Europe, USA, and Mexico. Major activities and achievements are related here to turnaround scenarios in multinational organizations and restructuring of operation and post-merger integrations. I'm living here now in Chicago for 12 months, and total in the USA, I stay now for 5 years. Thank you.
Okay, perfect. Just a couple of words about Rödl Partner. So Rödl Partner is a CPA firm started in the 70s in Germany and is now specialized in German inbound business. So we are in 49 different countries, including the US. We started in the US in 2001. Rödl Langford de Kock. So Langford de Kock was the firm that also started in the 70s and just specialized apart from Rödl Partner in that inbound business. And then we got this wedding together. And since 2001, we have joint efforts. We work in 8 different offices. We just opened Detroit, the Detroit office. It's our newest baby. But you see in the map across all of the East Coast our different offices. In total, we are 265 professionals now, and more than a third of them speak German. Having said that, that means that roughly 70% don't speak German. What it means is that we're a very international firm. In total, we speak 27 different languages. And also on partner level, you pretty much have the same breakdown, that a third of the partners in the US are Germans, and then 2/3 are non-Germans, Americans and South Africans and other countries. Most of our guys have a Big Four background, and we have a relatively high percentage of Wirtschaftsprüfer and Steuerberater that also are now CPAs in the US. Next slide. So here you see the different services that we have with Rödl Partner here in the US. So the typical CPA firm, except that we are specialized on the German inbound business. And 2 areas that are a bit more specialized is that we have the business process outsourcing, meaning that we embrace what our client needs in the beginning of his endeavor in the US, meaning that we can do all of the bookkeeping and all of the other administrative parts that are related to the tax returns, as well as the transaction services practice that I pretty much started in 2012. I took over the part-time job of our managing partner who was interested in that, and then I was the first fully dedicated person on that. And now we are 9 people working in the transaction services practice. And I think back to you, Garrett.
So yeah, Jennifer, could you introduce yourself as well?
I think Jennifer's frozen on my computer.
Yep, I think she's frozen. So until she's back, I would say let's continue with Janine.
Hi, can you guys hear me?
Perfect, yes.
Good. Welcome everybody. Thank you for joining, and Garrett, thank you for hosting this. I am a relationship manager with Bank of America based here in Chicago, and I work in what we call our global commercial bank. So that is middle market companies just like yourselves. I work fairly exclusively with the subsidiaries of foreign companies. So I work with a lot of German and Japanese subsidiaries here in the northern Chicago, northern Illinois area. Prior to being a banker, I worked for 13 years with Motorola. So I've sat in your shoes in treasury, in the CFO role, in corporate strategy. I actually worked in our M&A group for a couple years doing mergers, acquisitions, and divestitures. So I thank you for hosting, thank you for including me, and I look forward to a great discussion today.
Well, thank you for the introduction. We just saw that I think Jennifer had some internet connection issues. So I would say once she's back, we give her the chance to introduce herself again as well. So I would like to start with a couple of questions. So the first question is most suited for you, Frank. So what is the latest development in the M&A market, and how does it compare to the financial crisis?
Yes.
I think we also have prepared a supporting slide for that. So yeah, if you can collaborate on that, that would be great.
Right. So if you look at that, so I started in transaction services in 2001, which was a very wise decision because it was just in the beginning of the dot-com bubble, with a lot of spare time, not doing any kind of work. So this is the 4th crisis that we see since 2000. And if you look at the blue line you see is the MSCI World Index, and then the green line is the M&A volume, meaning the number of deals that you see worldwide. So you see that it was quite in the financial crisis, it was quite a longer process until we got back with the M&A business. And then this year's, as of March 2020, so on the right side, you see the sharp decline in the stock market, and that one doesn't show. We see it on the next slide, but stay here. the M&A market, of course, also went down significantly. The question is, what will happen now? Because if you think about it, if you see such a coherence in between the two graphs, and you see the sharp decline, but we all know that this decline has been rebound already in the meantime. So the MSCI is at 2,300 something. With what it means is, what does it mean now for the M&A market? So on the next slide, you see that the M&A activities have declined. This is North America, and you see in the deal value went down by 73%, and the deal volume went down by 35%. So somewhere in between is probably the truth that we have seen in the first half of the year 2020. Nobody would expect anything else, but it feels different. So I would say the financial crisis felt different because everybody was holding its breath and really thought about whether this is the end of the world. And right now with Corona, everybody is looking forward that it changes, but it may take some time. But it's not that anybody really has the impression right now that this is such a deep decline. Everybody is just asking, when does it go up again, and how does it go up? Is it a V shape, or is it something smoother? And then we suspect that the M&A market will go back up exactly in that perspective. Once we see positive news, I'm sure that this will go back up as well. But yeah, so it is a sharp decline. It was sharper than in the financial crisis, but the question is what will come next.
Okay, thank you so much. And we are glad that Jennifer is back. Jennifer, just to bring up to speed, the question was, what is the latest development in the M&A market, and how does it compare to the financial crisis? I know we just skipped that we introduced you, so if you just can give a quick introduction, and maybe if you have to add something to that question, that would be great.
Yes, I will. I do apologize because of the recent storms. Sometimes the internet connection is a little wonky. Sorry. I'm Jennifer Watson. I'm a partner with Masuda, Funai, Eifert, and Mitchell. I've been doing mergers and acquisitions for almost 20 years. I will say, recently we saw a very steep decline due to COVID, particularly with foreign buyers purchasing entities in the US. However, I do see that changing, particularly for those foreign buyers that have cash. I think there are going to be some good opportunities where US businesses may be struggling, that need investment, particularly for strategics. This might be a really good time, to reach out if there's some targets you're interested in the US, and see if it's a viable time to do a deal. I do think we'll see some comeback in the probably starting in September with transactions.
Okay, perfect. And Janine, do you have anything to add to that?
Yeah, I'll just kind of add that the loan market has seen a lot of volatility. So I would say in mid-March, when we were first put on lockdown, many clients drew on their revolvers, what's called defensive draws, right? They wanted to have cash on hand just in case they ran into top-line revenue problems. That is beginning to change, as both Frank and Jennifer have alluded to. We have seen more M&A deals coming to market, I would say, in the last 6 weeks. So buyers are accessing bank debt. They are willing to look at opportunistic deals out there when multiples maybe are depressed, and they can find some distressed but not extremely distressed companies. So I agree with what the other panelists have said. It did take a hit, but we are seeing some encouraging signs.
Okay, thank you. And describing the recent development in M&A activities, what you just mentioned, what would you say are the main issues in a COVID environment right now?
Is that for me?
Yes, if you want to take it, that's perfect.
Yeah, I think the biggest thing we saw is with uncertainty comes a lot of mystery about future cash flow. And when you try to get to a multiple or purchase price, discounting those cash flows is basically how you get to that purchase price. So when there's uncertainty, you see multiples really dropping. And for buyers, that's good, but a lot of entities that wanted to come to market and sell took a step back and said, hey, I'd like to wait for market conditions to improve. So that was the direct impact, is if we're going to see a second wave, is that going to impact my cash flow again? But we are seeing, as I said, some return to normalcy.
Okay, Frank, Jennifer, do you have anything to add to that?
Yeah, I would agree with that. I mean, my impression is that the sellers are still not desperate enough, meaning that the stimulus programs apparently have worked well enough so that they don't have to sell right now. In our portfolio of deals that we have seen, most deals were not related to any distressed business. And therefore, it's not that the prices went down significantly. Keep in mind, Germans tend to be stubborn anyway. So a lot of deals that started prior to Corona were not stopped. You know, they still moved ahead. They tried to get certain conditions into the LOI so that the exclusivity doesn't run out if the deal takes longer. And yes, most deals have taken longer in the negotiation phase. And then also, you know, the Germans recognize that if they cannot travel, that they don't see the baby before they buy it, and that is rather dangerous too. So they had to try to find certain solutions in order to still move on. And therefore, right now, the wave of deals with respect to the current impact on the market is, in my personal impression, is still yet to come.
Yeah, I think there's some still yet to come. We are seeing not necessarily fully distressed deals where sellers are in bankruptcy and doing 363 sales, but we are seeing some smaller acquisitions that are occurring because there are cash flow issues with the target, and they realize that if they are acquired by a stronger strategic, that will help them grow and give them assistance to get through if there is a second wave or not. But as far as, you know, value deals that you would see more likely on the private equity side, we're seeing less of that because valuation right now is very uncertain.
Okay. And then, Frank, you mentioned a little bit the impact of from COVID on the financial and tax due diligence and the process. Can you tell us a little bit more from your perspective on that?
Yes. I mean, apart from the fact that people cannot travel, by the way, I mean, that has worked relatively well. So, so the financial and tax due diligence, as well as legal and other due diligences, you can do them remotely as well. Environmental is probably a different story. They have to be in the field. But that has worked. But just the fact that you have to negotiate almost everything via phone instead of personal meetings is one issue. And then, of course, the uncertainties that we discussed already, it's tough to find common grounds on that. So therefore, we more often have disagreements about the price. If you didn't tackle that in the LOI, at some point in time, it will hit you no matter what. You know, people sometimes try to postpone the final negotiation in order to see what's going on in the meantime. Now everybody is, let's say, slightly disappointed that the Corona crisis is still not over, and people rather talk about a second wave than that it will be over anytime soon. So at some point in time, you have to face the fact that you have to negotiate a price, and if you cannot agree to that, well, sometimes it's the earnout. I think, Jennifer, you recognize that in your practice as well, that earnouts are definitely on the way back. You know, they were out of style, I would say, in the past. They were always on the negotiation table, but a lot of times they fell off at some point in time, just because it's very tough to agree on an earnout, agree on the basis. It's if you ask some people, they say it's the road to disaster, because you will have litigation problems in 2 years from now because the definition was not clear enough. And therefore, we haven't seen many earnouts in the past, but I think that is about to shift.
Yeah, I would agree with that, Frank. Well, and historically, we were in a very long seller favorable market as far as negotiation, leverage, all of that was very heavily favored towards sellers. We're now seeing a shift towards it being more favorable towards buyers. But again, as Frank said, one way to bridge the gap between what the seller wants and what the buyer wants is to have an earnout. We are seeing more of those. From a legal perspective, with earnouts, we work very closely with the accounting and tax providers to try to avoid litigation down the road, and to have very clear definitions. And we even use spreadsheets, how it's going to be, to try to avoid litigation. But there is always, no matter how well a contract is drafted, there is always some negotiation or issues with an earnout. But we will see more earnouts. Some of them may be based on revenue or cash flow. My personal preference is EBITDA, because that's really only cash in the bank that there is.
Okay, great. And you guys mentioned about distressed companies. So if a company is in a distress, so usually it goes a little bit quicker. So for the both buyers and the sellers, you would anticipate. So at what stage is it important for me to, involve for my due diligence, like a financial advisor, tax advisor, or also legal advising for my due diligence?
Oh, I would say from the very beginning, particularly if the entity is distressed, you need to move quickly. But also, you don't want to get trapped by your letter of intent if something should happen on due diligence. And you also may need to include in the letter of intent, what if that target had a PPE loan, and where are they in the forgiveness process? Is it going to be an asset deal or a stock deal? You also want to include some of the financial metrics, and I'll let Frank speak more to that.
Yeah, I mean, regardless of Corona, we have seen in the past too many times that the client calls us after he signed an LOI. And then in the LOI, you see the language, well, the purchase price is 10 million. And then it's pretty much silent. So it doesn't talk about the structure of the deal. It doesn't talk about whether it's cash and debt free. Sometimes it doesn't even talk about whether it's enterprise or equity value. So you didn't agree to an exclusivity phase that you probably want to have before you spend a lot of money in professional services. So it's a lot of different things. It could be that you want to talk about post-closing arrangements, that that the owner is still around in case you want him to be around, any kind of other conditions with respect to personnel that you want to agree, you as the buyer, and also any kind of definitions of working capital or net debt. If you see already, one of the typical breakers where you want to agree on that upfront is when you have a lot of customer prepayments, whether this is net debt or whether it's working capital. So there are a lot of items that you better want to agree, but structure, it's amazing how many LOIs you see where the structure was not agreed. And that is one of the major points, regardless of Corona. So if I only have 1 minute to introduce myself, I would say I'm Frank, and please call me before you sign an LOI.
Thank you. You also mentioned previously asset deal versus share deal, for instance. So why is this decision so important, not only for the seller side, but also for the buyer side?
Yes. If you go to the next slide, we have a couple of items included with respect to the asset versus share deal. So you see that in an asset deal you just buy certain assets, whereas in the share deal you buy the shares of the company. The major difference, and the reason why I always ask that in the very first conference call that I will ever have with a client, and I assume that the client is the buyer, is that they want to push for an asset deal, at least for tax purposes. So what it means is that if you have an asset deal, you can amortize the premium that you pay on this deal over the net book value of the assets. You can amortize that as part of the goodwill or as part of the intangibles for tax purposes as well. So that could be a multi-million-dollar difference, whether you can amortize that for tax purposes or whether it is just an investment on your balance sheet and it doesn't amortize at all, which is regularly the case in a share deal. So that's the reason why the rule of thumb is that the buyer wants to have an asset deal and the seller would like to have a share deal. The seller likes to have a share deal for various reasons, including the tax reasons. So what it means is that in a lot of cases, or in general, if you have an individual selling a company, he gets capital gains taxes, meaning it's a lower tax rate if he does a share deal. However, in certain cases, and that's what you have to look up front, it may not be a big deal for the asset deal instead. And therefore, that's one of those questions that you want to ask as a buyer at a very early stage, so that you understand the tax situation of the seller better. Because if you come around with the proposal to agree to an asset deal, even if you didn't agree to anything in the LOI, if you do it at a very late stage, the seller always wants to have a piece of the pie. So all of a sudden he argues. In Europe, it's a different story. In Europe, you oftentimes have two different purchase prices, one for an asset deal and one for a share deal. In America, in most cases, no, it's the same price and the buyer gets the benefits. However, if you come up with that negotiation point at a very late stage, then the seller may say, yeah, sure, but I want to participate to some extent because I'm doing you a huge favor to agree to an asset deal. What is interesting is that you have a specialty in the US which is called the 338H10 election. And that means that you have a share deal for legal purposes, but it's treated as an asset deal for tax purposes. You don't have this in Europe. It's an American specialty, and it could actually solve issues on both sides, meaning that the seller still sells the shares and he transfers all the liabilities that he wants, and the entire business is transferred. However, the buyer still gets the tax step up for his tax purposes. One of the reasons why you want to discuss, why you want to talk to your CPA prior to agreeing to an LOI could also be if you're the seller and you think about your NOLs. So if you sell your business, let's say most deals that we have right now, they are selling businesses that didn't do well, not only in Corona, but pre-Corona, and Corona is just the last straw, which is the reason why they want to sell. And then they have a lot of NOLs, so a lot of tax loss carry forwards. And then the question is, what is the optimal deal structure in that perspective? In most cases, they will just agree to a share deal, but then the buyer can only utilize a very small percentage of his purchase price per year as NOLs. It's like 1.something% of the purchase price that you can deduct your NOLs from future profits. So it's very minimal. However, if you have a lot of NOLs, maybe it's even advantageous for the seller to agree to an asset deal so that he can utilize all of his NOLs in exactly that sell and still not pay more taxes despite the fact he agreed to an asset deal. So those are some things that when you talk to us too late, then you don't want to come up with that change, because then as a seller you could really ask for more money by saying, hey guys, I do you a favor and you cannot utilize my NOLs anyway, but I can utilize it. Jennifer, you want to talk about the contracts and certifications for a sec?
Yeah, I can, and I'll also talk about liabilities because in general, when you do a stock purchase, you are buying all liabilities. They're all transferred, all assets, all liabilities are transferred. When you do an asset transaction, you can really pick and choose what liabilities and assets you want to assume. There are exceptions to that though. So I call them the 4 E's of successor liability, and that's mainly around employment, employee benefits, environmental, and export control. So even if you don't assume some of those assets, there's something called successor liability that they'll follow you. So even when you do an asset deal, you still have to look at those. There is an exception. If you're buying a business out of a bankruptcy code 363 sale, then you're only assuming certain liabilities, but that's only if you're buying out of the 363 bankruptcy process. And a normal asset deal versus stock deal, you still have to do a good amount of legal due diligence, particularly in those 4 areas for an asset transaction. And for contracts and other certifications, unless they have a change of control provision in the contract or based on state law, most contracts will transfer with a share acquisition. If there's a change of control provision in the contract, then sometimes you have to get consent of the customer or the supplier. For an asset transaction, most contracts have a non-assignment clause, and so you usually have to get consent to transfer all of the contracts and certifications as well. So some buyers actually may prefer a share deal, particularly if there's a lot of contracts, or particularly if there's government contracts. You may prefer a share deal just because you don't have to get a lot of consents. And that's something that should be looked at, not only for the LOI, but also for structuring the transaction. You know, if you find in due diligence that there's a major contract that requires consent for an asset transaction, but not for a stock transaction, you know, then maybe you have to go back and talk about how you're going to revise the transaction and the structure, knowing, of course, the seller is going to try to want to get more money from it, and the buyer's not going to want to pay more. So, but it's a negotiation process.
All right, thank you. Janine, do you have anything to add to that from a bank perspective?
Well, if you're the buyer, the sooner you can partner with your bank, the better, to make sure you've got the financing in line. If you are a seller, most banks, Bank of America does this, we offer M&A advisory services. So definitely the sooner you can bring your bank, your tax, your legal, all under the tent, you're just going to end up with a better outcome.
Okay,
yeah,
perfect.
And I think you're going to move faster too, because you'll have everything in line to begin with.
Okay, perfect. And then if we stay a little bit at the financing side, so Janine, the question is, I think, best suited for you. So for financing options, for if I'm a German company, what kind of options from a US bank perspective do I have in order to get a loan or any support from your bank, for instance? And what are the main criteria I have to fulfill?
Right. So as I mentioned, you are seeing banks opening up to this type of financing again. We had seen banks really focusing on current clients, meeting liquidity needs during the crisis. Banks have opened up. They are looking for new opportunities. I would say in this middle market space, most of what I see being at the bank are bank financings. On the upper middle market side, we do have clients accessing the debt capital markets, but those would be for very large transformative type deals. So we also see a lot of transactions where the parent company is willing to fund that acquisition through an intercompany loan. So I would say if you are interested in accessing the bank market, we want to see projections. We want to see kind of what that plan is. What is the strategy behind that? Tell us the story of why you think this target is going to add value, right? M&A deals, it's for creating shareholder value. So we need to see what that value is, how much thought and work is behind the purchase price. And it's basically kind of an iterative conversation with your banker to make sure they're comfortable with what that future state will be. What's the EBITDA expectations? What are the revenue synergies, the cost synergies? It's having a firm grasp that this will add value to your existing business.
Perfect.
Yeah, and I would say, just to add on to that, because Janine did talk about if the parent company is going to finance the acquisition in the US, if you are a buyer or a seller, most loan covenants that you would have with the bank are going to require consent for the bank for a change of control or to do a mergers and acquisition. So you really do have to reach out to your bank and look at your own loan documents as well. Even if the parent's going to fully finance it, if you have a credit agreement in the US, you really have to look at that to see if you need consent from your bank as well to go forward with the deal on buy or sell side.
Okay, thank you. So before we go and talk a little bit more about the cash flow management, Last question I have regarding to M&A transaction is actually for all of you. So number one, is this a good time for an M&A transaction? And B, based on your current experience and on the projects you're working, what are the main industry sectors you see are hot right now?
I'll start if that's okay.
Sure, go ahead.
So I think it's actually a really good time for foreign buyers to enter the US market and make acquisitions, particularly for strategics, because, and this is my opinion, but it's kind of what I'm seeing is a lot of the sellers are getting closer to retirement, and they made it through the financial crisis. They're getting ready to sell. Then we got hit with COVID. They may not have the stomach to try to pull through another crisis again on their own without a bigger backer behind them. I am seeing some transactions start in really high tech areas. I also think we're going to see them obviously in medical and medical supply is where I'm seeing some, particularly with the US, and as countries look at where their medical supplies are coming from and access to them based upon COVID. So I see those two industries being very active right now. I don't see automotive being as active just because of the downturn. I think food and beverage will continue to be active. I mean, one of my clients is very active in food and beverage, and it's because Americans like their snacks. And even if there's a depression, we're going to eat at home and we're going to have our snacks. So I think the snack industry and food, those probably will start picking up soon. But tech for sure, and medical.
Frank, Janine, do you see any trends there?
I'm happy to add, and yes, I agree wholeheartedly with respect to the sectors that you just mentioned, and we just recognize the same thing, which is pretty much that right now it's a bit in line with what we said earlier, that we think that the sellers are not desperate enough so far to sell in a distressed mode, and therefore the trends that we see right now are more the Corona winners than the Corona losers. So that's the reason why we see more deals in digital content, in pharma, in life science, in logistics, and less in the typical manufacturing distribution business. But that may come back as soon as those guys are really willing to go for a different price. But as of right now, it's more about the winners than about the losers. And we will see in the next couple of months whether that trend will then soften towards the more traditional deals, where the Germans were very, very active in the last couple of years. You know, I mean, the trend, or the general trend, especially since Donald Trump became president, was that he said, well, let's do a tax reform so that the corporate tax rate went south significantly to 21% instead of 30-something. And then the other thing is that he wanted to push international companies to produce locally. And that's the reason why we had a positive trend, especially with manufacturing and distribution, also from the German clients coming to America. And the question is whether that trend will then move on. But that, of course, went down slightly so far. But I would say that those has been the trend in the past, and the question is whether it will come back.
I would say it really depends if this is a good time. I think it depends on the industry you're in. It depends if you are borrowing to facilitate a transaction. I guess what we don't want to see are firms who are eager to acquire a target and they're giddy with perhaps depressed multiples, and then they expedite a due diligence process. They don't spend enough time, a disciplined amount of time, really getting to know that target. So there are great deals out there. I think if you are a borrower, spreads are still not at the pre-COVID levels. So I'm telling clients, if you don't have to open your credit agreement right now, don't open it. If you don't have to upsize, don't upsize, because you'll get hit with a LIBOR floor. you'll get hit with slightly higher spreads. But yes, there's good deals out there, but it really depends on your strategy. It depends on your credit profile. So stay disciplined to what your real strategy is. If there's something out there that fits, go for it, but don't use this time to panic buy just to obtain top line growth.
Okay, thank you. That was really valuable. So especially nowadays during COVID, I would say to have a stable cash flow, that's king. So cash flow management as well. So Bernhard, this question is actually for you. So what are the general criterions for good cash flow management?
Okay, yeah, good cash flow management. I think what should do cash flow management in a situation like this? It should support and follow up the activities of cash collections. That means to do a good cash collection, you need a solid base, and a solid base in this case is maybe a budget, a forecast, or you're doing really, you support your cash flow with a solid and reliable business plan. And then with having this, then the criteria of an understanding of a cash flow management is that you know your regularly cash in and cash out options, what you have, what are your spendings that you can most influence on, and on the other hand side, that you are knowing your cash situation on a short-term level, on a mid-term level, and a long-term level. I think this is the biggest criterions. All the rest, it's up, downs. The best is if you understand it, then you are up to your cash collection.
Okay, and do you see any special success factors to steer and to control the cash situation during this actual crisis?
Yes, there are maybe some things you have to do in this situation a little bit different than you have to do it under normal circumstances. I would say.
I also think we have some supporting slides for that, right?
Yeah, there is a supporting slide. There's the next one, I think, is it? Yeah, this one is it. Yeah, thank you. I think it's you need a little bit, not a little bit, you need a more extensive analysis of the environment. So, and as I mentioned before, and this is what I see at the moment in my services we are doing on the BPO services. It's you need maybe to set up a new business plan, like you do it as a startup. It needs a reliable, well-founded solution, a solid assumption business plan, and you need to regularly verify it because all the circumstances outside are changing, and maybe your internal assumptions are also changing. Your sales are changing, everything, and therefore it's important that you really understand your business in much more detail than you understand it under normal circumstances, because without this, you cannot react. Also, what is important, you have to set some parameters. I would say you need to set up a threshold for your business. You have to say for your own, as a business owner, what is the time I have to leave? This is very important because you need to see that this crisis impacts you in several ways. And the most way could be that your top line is not coming back. And then you have to see to what circumstances I will push up my subsidiary in the US, for example, with money coming from Germany, with money coming from abroad. So this is really, you need to think about this really straight. And also what is also important in such kind of actual crisis, you have to change your mindset. And this is what we mentioned already in the name of this panel here. Cash is fact, profit is fiction. You need to think about how you gain more cash. That means you maybe have to empower your procurement department to negotiate higher purchase prices with your suppliers, but on the other hand side, maybe have a lot more extended payment terms. On the other hand side, you have to empower maybe your sales department and negotiate different sales prices, maybe lower sales prices, but in exchange, the payment term, it's upfront or by delivery. So that really helps you to bring cash in your company back. So, and then nevertheless, it's communication. You have to talk to everyone. Maybe you have to talk to your suppliers, to your customers. You have to drive this and go into this communication. We can help you this. We are doing services also as the interim CFO, where we are taking care of you because due to the travel restrictions, you cannot travel. We can do something like this and be part of your company and doing something for you here, what you at the moment cannot be applied to.
Okay, so then if you, for instance, as an interim CFO, there are several corporate stabilization programs available in the US, if I'm not mistaken, and there might be some regional differences. Can you tell us a little bit more about it, and then how would that be applicable for companies here in the US?
Okay. Yeah, the most common stabilization program, federal stabilization program, was the PPP loan under the CARES Act. Actually, the funds are out, the application time, it's gone. And so at the moment, we are working with our clients on the loan forgiveness applications. And but there are also still regional programs available. For example, just one example, Oakland County in the Detroit metro area, they are dedicated over 30 million US dollars from the Federal CARES Act into a fund to help small businesses they are at the moment impacted by the pandemic. So that means also foreign-owned companies in construction, manufacturing, machinery business have a high chance to qualify for this small business recovery and resilience program. It's of course not that big funded like the FED program, but at least maybe you can gain something about 50,000 US dollars, and also this can be converted in grants afterwards. So programs like this exists, and there are existing a lot more regional programs on county, city level sometimes, but the requirements to be eligible for this very, very much.
Okay, perfect. And of course, this has to be then really investigated if you do your due diligence as well, right? So Jennifer?
Yes, definitely. If you're well, the PPP loan program, like we said, is out and it's done. If you are acquiring a company that did have a PPP loan, you really have to look at the terms of loan forgiveness and what impact that's going to have on the purchase price or the true up, like the working capital true up that you would have after closing if forgiveness is not received at the level that it's wanted. But definitely you'd have to look at that from a legal and an accounting side, what the implication would be. And you also have to look at the regional loan programs as well. As Bernard said, you know, Oakland County has one, Ohio has some. I've been assisting clients throughout the US with some of these, you know, more regional programs where they can apply for those. So it does provide cash, which is great. But if you're doing a transaction where you're looking to sell yourself, it's going to have an implication. And then, Janine, I don't know, where is Bank of America at with the Main Street loan program? Has that rolled out? That might be something to talk about along with cash flow management.
Yeah, thanks, Jennifer. B of A is a Main Street lender. We've been approved. To be honest, we don't see as many firms coming to access that program as we did under PPP. The reason being, the bank's underwriting criteria remains in place. So those firms who at this point are seeking Main Street lending loans, you know, they probably are having difficulties that preclude them from meeting the requirements. There are also restrictions on EBITDA leverage that make many companies ineligible. And that program is really a cash flow based lending program. So anybody that is kind of used to an asset-based funding program would not be eligible. So we're not seeing the take up with the Main Street lending program as we thought, but certainly we saw a huge transactional flow with PPP.
Okay, and then which internal measures should I take to stabilize my cash situation, Janine?
Yeah, I'm glad you raised this because I wanted to build on kind of what was said earlier. We are seeing clients who previously did not do a daily cash position really bring discipline into their cash management practices. So we are seeing firms do a daily global cash position, leveraging any technology that they can, including their bank's online platform, to really bring in all of that cash data globally into one platform. So getting visibility and control over that current cash is vital. But then second, we're seeing firms really build out a cash forecast. So what's my future cash going to look like? So I would say those two things right now are really what companies are focusing on, getting daily visibility and control over cash, and then building out a global cash forecast so they can anticipate any problems. And like what Bernard said earlier, playing around with your receivables and your payables to really squeeze as much cash, internally generated cash, out of your working capital management as possible, because that's free cash. That's not going to cost you anything. So managing working capital has become a probably a third priority right now.
Mm-hmm. Bernard, do you want to add anything to that based from a CPA perspective?
Maybe more from a professional perspective, not from a CPA perspective. It's really cash flow management is very, very important at the moment, and not to look so much on your P&L and what is the net income and so on. You cannot buy nothing for the net income. The only thing you can use is the money you have at your bank, and this is very important. And therefore, it's build up a cash flow management, build up a cash flow reporting, and even if you're a smaller company, maybe you cannot do it on a daily basis. This is okay, but try at least on a bi-weekly base to gather your cash statements, to review your bank statements, and maybe then if this is not coming as planned, think about what you can do. Maybe start talking with your supplier, start talking with your customers. Also, maybe also talk with your employees, or such a thing like talk to your landlord. Maybe you can postpone for 3 months, but by extending the lease, for example, do something with your cash. Everything what you can do on your own, it's much cheaper if you have to go to a bank, or maybe then you come up with some M&A activities.
Mm-hmm. So with the cash flow, how much cash flow would you say do I need for my company? Is there any rule of thumb, any general rule existing based on your experience? I mean, of course, it depends on the size of the company.
I think there is no general rule how much money I have to be in my pocket. This is it's very difficult. I think you can read so much books of it and can bring days in the internet and get so much different kind of numbers and KPIs. I think, and this is what I worked for over my last 25 years, there are 3 major KPIs you can use. This one is the quick ratio, then the other one is the cash conversion. The next one is maybe at the moment a little bit difficult, a sustainable growth rate, because the question is you can grow at the moment, but we will see. Quick ratio is just that shows how much ratio between your accounts receivables and your cash on one hand side versus your current liabilities. That means how fast you can pay back your actual current liabilities you have to pay. So and this should not be a different factor than 2. That means the accounts payables should not double the accounts receivable and the cash. Then you are still in a okay world. Also, other thing, it's cash conversion rate. This is an indicator about the time that the cash is tied in your business processes for accounts receivable, for accounts payables, within your working capital. And as longer this period of time is, and you can compare it just to your past, and you have a figure that you can compare with, as much more attention you have to pay to this. And then third figure is sustainable growth rate, is just that you measure how much you finance your growth with your own money. So not go to a bank to finance your working capital. This is just how you finance your business with your own capital. I think when you are looking on these three figures all the time and have this under control, then at least you are doing a good cash flow management.
Okay, so what specific steps are Rödl Partner, for instance, actively accompanying in cash flow management, and maybe what role could Rödl Partner play as an active cash flow manager?
Yeah, what we can do, we can maybe play, maybe we can show it on the next slide of the presentation. What we can do is we can take over the position of an interim CFO, as I already mentioned. So if you have at the moment travel restrictions to the US, we can help you out. We can try to be a communication platform between your business here and you in Germany. This is at least with the language can help. So at least this is something. We understand your concerns about how this looks in HJB and how it looks here in US GAAP. So maybe in this case we can help. Also, we can take over accounting and controlling work on a day-to-day business, or doing just cash flow working capital management for you. But also, of course, we support you as a tax consultant. If you are have the opportunity to get tax money back, yes, of course, we can take over this position and help you out to get this tax money as soon as possible in your bank accounts. And of course, standard business consulting we are doing, negotiation support for M&A activities, other standard business consulting. Maybe you will work on your operations, or you will work on your reorganization of your departments. We can help with this. And what also we can do is really to support you in activities to get banking legal advice. We cannot do it by our own, but we can support you with the right legal advice for your special issue, or with the right banking advice for your special issue. We cannot do this in purpose, we cannot, but we can this as a consultant.
Okay, perfect. And so take a look at the time. Some of my last questions are basically, before a deal actually closes, what should a buyer be aware of? Janine, I would like to address this question to you first.
Thank you. I think what we are seeing when we looked at our research, that the time between when a deal is announced and when it actually closes is shortening up. Right now, that's about 89 days. So that doesn't give a lot of time to the CFO, treasurer, controller to prepare for that day one readiness. So given that short time, develop that future state vision. Think about what this combined entity is going to look like. We always say day one readiness should focus on cash. As we've discussed, cash is king. You want to have visibility and control over that cash on day one. So bring your bank in early. You want to make sure that wire that's going to purchase the target goes through. If there's an FX component, you want to make sure that your bank is prepared to have the FX funds available. You want to make sure you've got access to all the systems, the ERP system, the banking platform. If there's a treasury management platform, you want to make sure that you will have control over the cash on day one. Bank of America has a checklist that we give clients. Here's kind of what you focus on day one, 1 to 30 days. This is what you should be looking at, kind of 30 to 90 days. So Garrett, I think you have that. If anybody is interested in kind of that broader checklist, we can share it with you. But plan, 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 because you've got a very short window to capture those synergies, whether they're revenue synergies or cost synergies. You've got to follow that implementation plan to make sure that deal brings the value that it was modeled to bring, to make sure that purchase price is really getting you the value that was modeled into it. So what is it? Plan twice, cut once, something like that, but plan and then execute flawlessly.
Okay, perfect. Then the next question I would say after deal closes, because that was basically what a buyer should be aware of, but after the deal closes, what should a buyer be aware of? I would just put this question out there, whoever wants to take it first.
Well, I'll take it again because this is something we do every day with our clients. So typically there are significant cost synergies modeled into a transaction, and there's a large Excel model that this is all identified. You want to make sure that all parts of your business know what the synergies are and the time frame in which they're expected to be achieved. So as we said, cash is king. Minimizing your expenses, especially in the crisis period we're in right now, is critical. You want to capture those cost synergies, bring value to that deal, make it accretive as quickly as possible. So again, looking at working capital, we've already talked about this, but understanding your targets' working capital cycles is going to be critical for you to capture those synergies and squeeze that cash out of their working capital cycle as well. So really understanding what that integration plan is across all parts of the business, understanding what the cost synergies are supposed to be, and then capturing those and making the deal accretive.
Yeah, I would agree with all of what you said. What is critical is, and it may be more critical than ever, is communication. So, I have had one deal which was postponed by the seller because he didn't want to tell, it was a consulting business, because he didn't want to tell his employees that he's about to sell this business via video call. And therefore they postponed the entire deal. It will still happen. They're supposed to close tomorrow. But there was, it was really so key for the seller to bring his employees up to speed so that they also don't leave and say, well, now I don't know what's happening. So the strong story that you want to tell as a buyer is also very key to get transferred as soon as possible. It may not be so critical, a lot of deals that fail after 1 year, it's because people leave and because they were uncertain about what will happen, and they just don't like the new owner, or they don't know the new owner enough. And that's the reason why they think, well, before I really try to figure that out, let's see whether there are other opportunities. Those opportunities may not be that big in these times that much. Therefore, we also don't see that a retention bonus is such a big topic right now. It has been a bigger topic that you identify the key people and that you make the key people happy so that they stay at least for a good interim period until you can really convince them that it's a good time to or good opportunity to stay permanently anyway. That may not be the big topic, but telling your new company and those employees what your strategy is and what your 100-day plan is post-transaction is very key. And it may be tough if you cannot travel. So ideally you have somebody locally who's also your integration manager. So it really depends on whether you already have US activities so that you can engage somebody to be the integration manager, or whether this is just a start for you to get into the US business. That of course is then a bit tougher, and you have to see what your options are in order to be in the field and to make sure that the integration and your goals will get across as soon as possible.
Jennifer, can you add anything to that based on your experience?
Well, I think, even before COVID, integration was always really important to maintain value or receive the value from the transaction. But I think with COVID, the timeline for integration is shorter, just because you're in a more critical situation. So I think you need to be thinking about integration even when you're preparing the LOI. What is this going to look like? And put that plan together, as Janine and Frank said, and work with your bank, your accountants, and your legal advisors on what needs to be integrated. Because when we're doing due diligence, yes, we're looking for red flag issues that say we don't want the deal to go forward, but we're also looking at issues to say, after the closing, here's what needs to be worked on, and add that into the integration plan.
Okay, perfect. So then the main question, because we are close to the end, what would be your number 1 and 2 key facts, what you would say or would you advise anybody who is interested in an M&A transaction? What would you tell them in a nutshell? If this is your 30 seconds pitch. I know in between we covered a little bit here and there, but no, that will be your chance for you as a specialist and all the different processes of an M&A transaction, basically. So what would you say, what is the key factor from your perspective? Whoever wants to go first.
Well, make sure that you have enough time for it. So what we see is that people are, 120% busy with their daily work already, and now they want to do a deal. And this goes for both the buyer and the seller. So just make sure that your day-to-day work works on autopilot as much as possible, so that you can focus on the deal. You don't have much time in Corona times. You even have less time. Probably it depends. But typically the rule of thumb is if you need more than 6 months, which now sounds like a long time period, but if you think about it, from starting from negotiation to finish, something between 3 and 6 months is the normal time period. But if it takes longer than 6 months because you're not really focused on this, and it's more like a nice to have deal, and you're not sure whether you should be serious about this, and you let it go a bit, there's always a certain break point when one of the two parties will just have a sour taste about the whole deal and it goes south. I mean, we just had a new record that a deal took more than 2 years to close, and it actually closed, but you don't want to have that. So just make sure that you are focused on all of the questions and decisions that you have to make throughout the process.
I'll go next. My words of advice would be don't overpay. Depending on what study you read, a very large percent of M&A deals are not accretive. So make sure this is not an emotional decision. Make sure you've got the right data in the data room. You're doing a thorough due diligence. You've modeled this out, and you are not overpaying. But then once the deal closes, you got to make that deal accretive. You're using shareholder funds. So, focus on the right integration strategy.
Yeah, and I'll add to that. It's focusing on the right integration strategy, but I do think that there are a lot of opportunities available now, particularly for strategics, to add on and gain technology that they may not have or that they may be able to build upon. And definitely don't let the deal heat make you overpay, as Janine said. Sometimes, I tell my clients the best deal is the one that doesn't happen because the value wasn't there. You were just emotionally connected.
Bernward, anything from you last at the end of this panel?
It's difficult to say something about M&A, but I will say maybe something about cash flow management.
Yes, please.
Not a problem. So for good cash flow management, start with a business plan. Think about how your business will look like from now on into the future, and really think detailed on it. So, and then based on this, you can build up a good cash flow plan, and then you have a number you can rely on and can work with. So, and not use a budget maybe built up last year or something. Think from scratch on. What will it be, how it will look like, and what do I need really to have a good cash in hand to survive this pandemic. This is my advice on this case.
Okay, perfect. I don't see that we have any additional questions from the audience. So on this part, I would very much thank you all for participating, especially you as panelists. Really appreciate all your value, information, and everything you experienced over the past couple of months, especially now during COVID. For everybody in the audience, I would just like to mention that there's certain handouts you can download. If you have any questions afterwards, please feel free to send me or any of the speakers an email with your questions. All the contact details, you can find them as well in the handouts. In addition to that, at 2:45, so in roughly 20 minutes from now, Central Time, we have a roundtable with a focus on 50 states and 50 tax laws. So if you have any question about all the different taxation and all the different states in the US, if you're interested, for instance, in e-commerce and have a lot of question about what are the taxations there, please join us there. The link can be also found in the handouts or on our website, so there's still a chance to sign up for that. And with that being said, thank you so much for being here, for all the panelists, taking the time. And I hope you have a great rest of the day and stay safe and healthy.
Thank you. Thank you, everyone.
Thank you. Bye-bye.
Take care. Bye-bye.
Bye.
Bye.